Welcome to It's the Economy. Another day, another low for the rupee. The Indian currency touched 90.40 to the dollar earlier today. Yes, it has been the worst performing currency for a better part of 2025, but the 2% fall in the past 2 weeks has been particularly shocking. The Reserve Bank appears to have taken a more hands-off approach. In that case, where do we see this rupee headed? 90.40 today, is it worse? I have with me someone who has tracked the currency for a long time, Kamakshya Trivedi, the head of global Forex, interest rates and emerging markets research at Goldman Sachs. Kamakshya, thank you very much indeed for joining us. I know it must be a tumultuous day in the dealing room. To cut to the chase, it has been a slow grind for the rupee. First up, how do you explain this sudden collapse, over the last 2 weeks?
It's been, quite a steep, move in the rupee, certainly weaker than we had anticipated. I think there's a couple of things going on here. I think the fact that, after a little bit of a better inflow picture into Indian equities in October, you've seen a little bit of a flattening out there. I think there was some anticipation built up that a trade deal with the U.S. was imminent. That's obviously been, those expectations have been tempered somewhat. And I think equally on the other side, I think you've seen a shift in, the policymakers, the RBI's management of the currency. There definitely seems to be a greater willingness to accept volatility in the rupee. We've talked about that in the past. I think that's broadly a healthy thing. But I think what you've seen in the last couple of weeks is that tolerance for greater volatility, certainly on the weak side, seems even greater than we had anticipated.
Okay, I'm still looking for reasons for the recent sharp fall. Kamakshya, the fall was sharp on December 1st. That's on Monday onwards. Is it because on that day, the Reserve Bank released the second quarter BOP numbers, balance of payments data, and then we knew that the current account deficit for Q2, September quarter, has spiked to 1.3% from just 0.3% in Q1. Do you think this data has triggered a fear that external factors are way weaker than we thought?
I think that is, not just a fear. I think it's the reality. I think that the tariff hit against India has been, worse than, many people anticipated, more than we anticipated, certainly at the start of the year. The trade deal, like I said, I think there were some expectations that it was imminent, perhaps, even something that, ministers and others sort of pointed out, that sort of pushed back. And while that is happening, you've seen weakness on the external side. You mentioned the current account, that's certainly been weaker, but it's also been something that's visible in the forward-looking survey data. New export orders, for example, in the manufacturing survey that just came out, the PMI, that's one of the weakest it's been in the last several months and quarters. So this is having an impact. There's no question about that. I think currency weakness is one way to respond or one way to adjust to kind of that type of external shock. That's part of what's playing out. And I think the inflation picture, Latha, I think is also playing a role here. I mean, currency depreciation can be quite costly if it comes at a time when inflation is high and above target and accelerating. So I think the fact that the inflation picture looks pretty benign right now, that might also be giving more confidence to policymakers, the RBI, that they can allow a bit more currency weakness to offset this tariff hit, to adjust to this current account weakness that you mentioned without taking risks on the inflation side.
No, actually, I don't know, maybe you heard the CEA, Chief Economic Advisor, yesterday. He said exactly that the rupee's fall doesn't give him sleepless nights. And that's because he said this is the best time to let it fall. We are not worried about imported inflation considering how low CPI is. Now, with this let go of approach, the rupee at 90.30, 90.40, do you think it becomes a screaming buy, not just from RBI, but from the market?
I think that, you have to think about the starting point here. The rupee was starting from an overvalued level a few months ago and certainly a year ago, and we've essentially eroded all of that overvaluation in real trade weighted terms, and now you have, a small undervaluation. It's a small undervaluation. It's not a big one, so I don't know that in and of itself, that or the 90.3 level is sufficient to get, people come back in. I think the overall sentiment and, needs to change. But I'm quite optimistic. I think that the underlying macro picture in India is less negative than the sentiment suggests. We just had a bumper Q3 growth number. Inflation is pretty low. What is true, however, is that those positive macro fundamentals, notwithstanding the current account weakness that you mentioned, is more likely to show up in equity prices, more likely to show up in the fact that equity markets, start to perform again. That's our expectation. We have upgraded India equities after a year. And so I think slowly as those inflows start to pick up, I think they will find their way into stabilizing the rupee. But I'm not sure that 90.3 is the line in the sand where people come back in, just because the undervaluation is just not deep enough yet.
Your own forecast, I read a Goldman Sachs report of November 28, and that report said that the rupee will appreciate to 87.50 in 6 months and then to 86.50 in 12 months. Now, will you guys rethink your forecasts?
I mean, if you look at the way, at least the spot exchange rate has behaved over not just the last few months, but over the last, I would say 5 to 10 years, you tend to have essentially these bouts of depreciation and then a kind of stability in the dollar INR cross rate. And that stability relative to inflation and relative to the rest of the currency complex is part of what contributes to the kind of real appreciation that you saw in the currency over the recent years. So I think it's, one of the things that we will have to see, and, we'll see the revealed preference here, is this new regime with higher volatility, something that even the IMF recognized in its change of classification, is that a two-way volatility in the currency? So is dollar INR, does it also go down like it went up? Or do you have essentially more volatility one way, which is on the way up, but then you go back to that kind of stable path going beyond? And I think that's the real question over here, which is that, the macro, as I said, I think is I'm pretty optimistic. I think if you get that trade agreement, I think that there's, fundamental grounds for the equity market to do better, for earnings to pick up, for inflows to come back. But I think the important question at that point is this new regime one where, you also see kind of a move lower in dollar INR, or just a kind of stable move? I think given past behavior, I think stability is more likely than a sharp appreciation of the kind that we had forecast.
I would agree with you there. First of all, RBI will want to buy dollars to replenish their reserves. As well, in a trade war regime, it's good to have a cheap currency. But let me come to the most important near-term question, the most important. Do you think the rupee's rapid fall will weigh on the Reserve Bank tomorrow when it makes its policy and, prevent it from cutting rates?
I don't think so, to be honest. I think that there is room here to ease policy. I think inflation, not just in its last release where headline inflation fell to one of the record lows, near 0%. But I think just generally inflation has been reasonably benign. I think that, a rate cut seems appropriate here. And I think, the weakness that we've seen in the rupee, while, it feels, pretty bad in the last week, in the last few days, as I mentioned, only brings back the rupee to a modestly undervalued level on a real trade-weighted basis. And it comes against a backdrop where the current account is weak. India has faced some external shocks. Tariffs are high. And so a weaker currency is the most natural way to adjust to those shocks. I don't think that should stop the RBI from cutting rates. We think that they will cut rates. And so I think, I don't think as of now the moves we have seen yet are a cause to really halt that cut.
Okay, let me dwell for a bit on the other central bank, the Federal Reserve. Your report also said that you'll expect about 3 cuts from the Federal Reserve starting in December itself. What will that do to the dollar? The DX actually has fallen today. So what do you think will happen to the dollar?
Yes, we expect the dollar to weaken further. If you again step back, the dollar came from a situation which was very highly overvalued at the start of this year. And what we've seen is that the U.S. economy is no longer as exceptional as it was, compared to last year. U.S. markets have not been as exceptional as compared to last year. It's been a much more balanced global growth profile across the world, a much more balanced equity return profile across the world. And that means that the dollar's high premium, the dollar's rich valuation needs to erode somewhat. That's already happened. We think more of that will happen as the Fed cuts further, as the weakness in the labor market becomes more apparent as you get the new data following the shutdown. Both of those forces, alongside that more balanced global growth profile, should push the dollar weaker from here. We think, another, 3-4% in trade-weighted terms is a kind of reasonable expectation over the coming 12 months.
Okay. Speaking of interest rate differentials, let me come back to India. We have seen some 17 billion of equity outflows by foreign equity funds, but bonds have actually seen an inflow of $8 billion in 2025. Do you expect bond funds to be attracted now that the currency looks cheap and Indian yields are still high?
I think there is India is an interesting market for global bond funds. I mean, I think, and particularly so within Asia for some of the reasons that you mentioned. I think when you really zoom out across broader emerging markets, the truth of the matter is there are some other places which look even more attractive than India, right? I mean, you have places like Brazil with, 15% policy rates and, 4% inflation. There's a start of a sort of big cutting cycle that can come in Brazil. You look at, again, South Africa, they've had sort of, some structural shifts in their inflation target. Obviously, the bond market has performed very well already, but I think, global bond funds are, very much involved there as well, reflecting and playing for the flattening of the curve there. I think the opportunity in India is there, but it's somewhat smaller, for example, relative to some of these other markets, but it's bigger compared to the lower yielding parts of Asia. And so I think there's definitely going to be interest. I think the sell-off in the rupee, given the carry that you mentioned, I think, on the margin adds to it. But I also think you need to get past some of these risk events. I think people will feel much more comfortable getting back into Indian bonds, into Indian equities. And we've seen a little bit of that. As you said, there's been lots of outflows of Indian equities, but there's been a little bit of a pickup in October. I think as you get past the risk events to do with the tariff, spat with the U.S., if you get to a better place on that, if you get to an agreement on that, I think people will return to Indian markets quite swiftly.
That's the whole problem, isn't it, Kamakshya? We've been waiting for this deal and waiting for this deal. Now, let us hypothetically assume the deal doesn't happen soon. Not in a month, not in 2 months, not in 3 months. Will foreign investors continue to shun India? Is this deal such a big deal?
I don't think it's such a binary event, but I think it probably will help sentiment. And I think, it's not just what is going on with respect to India. I mean, global investors have a choice. And so to the extent that, it's leading to better trade outcomes and better market outcomes in other parts of emerging markets, for example, China, which were a big underweight for a lot of emerging market fund managers for a long time, even as India was an overweight, you're seeing a little bit of that shift. And I think that to change the kind of sentiment dynamic, I think, the trade deal could be a kind of quite important catalyst. Without that, it can still happen, and we think it will still happen, but it's going to be a much more slower moving process. It's going to rely on earnings gradually getting better. It's going to rely on that fundamental basis for the Indian economy gradually getting better. And it is better. It is resilient, like I said, but I think it will take more time. Whereas I think something like that trade agreement, I think, could really catalyze that shift in sentiment much more quickly.
Oh, yes, we've all been hoping for that. Thank you very much, Kamakshya Trivedi, for joining us. At the moment, the rupee has just recovered a wee bit from that 90.40 level or 42 level that it touched earlier today. The feeling is that Reserve Bank may defend 90.25 to 30 for some time now. And the next line in the sand is seen as 90.45.50. They seem to be defending these whole numbers, 25, 50, 100. So 50 is the next level the market is watching out for. On that note, wrap up on Bazaar Chartbusters coming.